I'm Diego Sanchez, president of HousingWire, and this is 10-Minute Talks. My guest today is Chris Morton, Chief Advocacy Officer of ALTA. Chris, welcome to 10-Minute Talks.
Thanks, Diego. Great to be with you. Appreciate the invitation.
It's so great to have you on. Before we dive in, could you give a 60-second introduction of yourself and of ALTA?
Sure. So ALTA is a national trade association. We represent the title insurance industry, which includes agents, underwriters, settlement service providers in the United States across every county nationwide. So the association works to advocate on behalf of our members and those we serve in the market, provides education, professional development for our members, and we promote industry standards. So that's a little bit about us. In terms of my role at ALTA, you mentioned I'm the Chief Advocacy Officer. So what that entails is I manage a team here that really is responsible for education and advocacy at both the state and federal level on legislative and regulatory issues that impact the title industry and for those we serve, obviously. I also oversee strategic communications efforts to highlight the really important role that our industry provides in ensuring the integrity of real estate transactions and the protection of property rights.
Over the past year, there's started to be a little bit of competition for the title industry in the form of title alternatives like attorney opinion letters. What's your outlook on these title insurance alternatives?
I really appreciate the question and this conversation. Let me start with just the competition piece, if I could just address that sort of upfront, because I think it's important. Our members are in the market competing really every day for business on a variety of factors. It's not just price, but it's service, it's transaction times and efficiency, among other things. And overall, there are 50 licensed title insurers nationwide in the United States, and there's over 17,000 title agents across the country. It's also important to recognize, I think, that from a composition perspective, 90+% of the industry is comprised of small businesses that serve their local communities and consumers every day. So competition really is inherent and welcome in what agents and underwriters do every day. But to your question, I think it's really important to state clearly that the variety of emerging attorney opinion letters that are in the market are really not, from our view, subject to the same kinds of regulatory oversight and scrutiny as title insurance products are, despite some claims to the contrary. And I would say also that AOLs really don't provide the type of comprehensive coverage for title risks that are offered by title insurance products. Again, despite claims that coverage is full coverage in terms of some of the alternatives, they only really provide coverage for title defects found in a public record search. And that significantly leaves out the protection for some of the most important, I think, in growing title risks.
Could we dig in a little bit there? I'd love to have you compare and contrast title insurance with AOLs and other title alternatives, in terms of coverage, in terms of risk, in terms of other metrics, price, and give people the full picture.
Yeah, no, appreciate that. So let me start by in terms of going deeper on the question of regulation. So really, title insurance is comprehensively regulated at the state level. That's our primary level of regulation by departments of insurance. Title companies are required to file policies and rates to ensure they're fair, non-discriminatory, and that they adequately protect consumers. And that includes in terms of having reserves to cover claims risk. With AOLs, I know there's been a number of conversations about state bar oversight. And state bar oversight is really limited to licensing and ethics. It's clear that they don't provide at the state bar level consumer oversight nor regulate attorney practices or work products specifically. So I think that's an important distinction. I would also say for those products that are described as having some sort of insurance component in terms of the alternatives, errors and omissions policy insurers are not overseen for managing title risk by state regulators nor approved for such. And so I think that's also important to make clear. As it relates to the second bucket, which is coverage, again, AOLs, and this is, I think, admitted by alternative providers as well, can't provide coverage for title defects that are not discoverable in a public record search. And I think that's significant. As an example, we had a recent study that was commissioned by Milliman, the actuarial firm, which looked at the industry's title claims over the last decade and found that nearly 30% of title insurers' losses and claims expense over the last decade really arose from issues that were not found or could not be found in that public record search. So a great example of that would be the area of fraud and forgery. So the Milliman analysis showed that fraud and forgery claims cost on average over $143,000 per claim. That's really significant when you're looking at that kind of a concern. And not only that, but if you look just in the last couple of years, in the category of claims that includes fraud and forgery, which is the category of basic risks, we've seen it almost doubling of the percent of claims in that fraud and forgery bucket due to things like cybercrime and other types of predatory activities that are out there. And so that is a real concern, from a coverage perspective with these alternatives. On the cost front, I think it's important to talk about some basic facts about the marketplace as it relates to title insurance and customs and sort of how that works. So in addition to the significant concerns and the gaps in coverage that I mentioned, there are real questions, I think, as well related to these alternatives in terms of purported cost savings, given the lack of sort of oversight from a regulatory perspective. And quite frankly, there's not been a lot of transparency in terms of the product structure and some of that on these alternatives. So in the majority of states, the fact is, if you look at a purchase transaction, in the majority of states nationwide, sellers pay for the cost of the owner's title insurance policy. And in that circumstance, the consumer is only paying for the lender policy at closing. Now, in addition, you have in the industry what are called simultaneously issue discounts. And so when you're purchasing an owner and a lender policy at closing, or it's being offered in the seller pay states, you're only paying for that lender policy, and with the simultaneous issue discount, that policy could be a couple of $100s. And so, from a cost comparison perspective, clearly in that circumstance, you're looking at a situation where not only are you getting a product for less cost, but more coverage if you're getting that lender title insurance policy. So again, I think it's really important to speak to some of the facts and make sure people understand those comparisons and choices. The other thing I'll just mention on the refinance side, because I know there's a lot of discussion about refis and costs of refis from a lender policy. For instance, if you're not doing a purchase transaction, so you're not getting an owner policy. In the refi context, there's also reissue rates that are offered by title insurance companies to borrowers in those circumstances because there may be in that circumstance less underwriting that's taking place, given the period of time, for instance, from the last mortgage that was issued for that borrower on their property. So I think oftentimes, quite honestly, we don't have a fulsome discussion about those different dynamics and those different sort of cost points in the overall conversation. And I think it's just really important, as we talk about this.
Yeah, that's very helpful detail. I wanted to talk a little bit about title insurance market share. You mentioned 50 national providers, but if you look at market share, it's really dominated by the big four, which are Fidelity National Financial, Old Republic, First American, and Stewart. Over 80% of market share dominated by those four firms. Do you see that market share dynamic as competitive, anti-competitive? What's your view on that?
Well, so again, I would say this: there's competition at work every day. If you had my role and you were in the market talking to our members every day, you see and hear about it constantly. And they're making investments in people, they're making investments in offices, they're making investments in technology that really speak to the work that they're doing to compete in the marketplace with the amount of sort of people out there from a licensed title insurer perspective, as well as the agent population. But on the insurer side, if you look at where the growth has been in terms of the market dynamics over the last several years, the growth really has been in the mid-size underwriters who've really gained, additional market opportunity, doing some things that are, interesting and dynamic, as well as some new entrants. So again, I think there is plenty of robust competition, and the indicators are that's where that growth is taking place, from a market competition perspective. I would say also, again, just on the agent side, that there is vigorous competition among agencies daily to serve consumers. So we're seeing, conversations that take place often around factors, again, service, the value that's being provided. It's not just a cost exercise. It really is a comprehensive look at local knowledge, how you have engaged and how long you've engaged in a certain local marketplace, and how you can be efficient in your transactions and close those. And I'll just give you one indicator of all of this that I think is important at a time when we think about increasing costs on a whole host of fronts. We're talking about it obviously in the housing affordability space, but we're talking about it for all consumer goods. There's a lot of cost increases. If you look at the cost of title insurance coverage, however, over the last 5 years alone, there's been at least a 5% decrease in the cost of coverage. And so I think that's an important indicator, again, of where the industry has come and continues to move towards in terms of investments that they're making in technology, in other efficiencies that I mentioned. So that's important. The final thing I'll mention here that is also, I think, something that your listeners have to recognize, which is, if you look at the overall housing affordability picture, and we certainly, from the perspective of the industry, want to have and continue to have thoughtful conversations about ways to address that. Title insurance, one of our members did some analysis that showed that title insurance really is overall, in terms of the life of the loan costs in a mortgage transaction, one of the smallest costs associated with that. And that's behind government taxes. It's behind fees that the government-sponsored enterprises, Fannie Mae and Freddie Mac, collect. It's behind investor costs and those kinds of things. So again, I think context is important. I think we're all part of solving the affordability challenge, but I think it's also important to recognize where those drivers are. And ultimately, overall, we know that there's a need to build more housing and that there's a need to reduce regulatory burdens that are out there in the marketplace for development. And I know a lot of people are working towards that.
Yeah, absolutely. So my final question is, you actually referred to title costs on refinance transactions earlier in the conversation, and it sounds like you might agree that there could potentially be some lower costs associated with title in a refinance transaction. The Biden administration seems to agree with that as well. Isn't that sort of a common sense approach that would help consumers to lower some of those costs?
So again, I would say we welcome thoughtful conversations about policy judgments in this area. I would say specifically though, no to the question about the approach that's being taken by the administration as it relates to waiving title insurance on loans purchased by the GSEs and assuming that that is the way to go at housing affordability. And I'll say what it is going to do is increase risk and allow the GSEs really to get into the primary market, which is a business from a title perspective that they really do not understand, nor are they set up to conduct. And so I think from that specific sort of area of focus in terms of this title waiver program, I would say no, that's not the approach that should be taken. And we have, not only do we have concerns, but I think you've seen policymakers on a bipartisan basis raise these concerns for quite some time. I would say it's bad policy. I think the process has been terrible in terms of the ability of open dialogue through a public comment process that hasn't taken place. And that really does matter because it helps make judgments, policy judgments that are more informed. So you look at this program that the administration's putting forward, and it's really focused on refinances for those with significant equity in their homes. So you're automatically talking about wealthier borrowers who have 20% or more equity in their homes. It doesn't target the first-time home buyer or the low moderate income home buyer. And so, it's really misdirected from that perspective, and it's going to increase potentially risk to the system and risk, to overall to the housing finance arena. So from my perspective, that's where we sit. I think process-wise, let me talk about that for a moment, which is, this pilot's not new. Back in 2023 in the spring, the director of FHFA was before the House Financial Services Committee and received a number of very concerning questions about the purported pilot that was being explored at that time. And as a result, they actually determined that it was not a program that they wanted to move forward with and put it on the shelf. And then, in fact, it was resurrected, in March, right on the day of the State of the Union, and done without any kind of open public comment process. And I say that because the FHFA itself has a process called the New Products and Activities Rule that they put into place. It's their own rule that allows for public input. They used it just recently on a program that Freddie Mac pilot program they were looking at in terms of second liens. And so in this instance, it wasn't done. And I would say that if we're going to really have a robust and thoughtful conversation at a minimum, you really should look to get comment and input from those who do this for a living and the experts who have, lived and breathed it. So, Diego, I think we can talk about important questions of affordability. We can talk about refinances and the costs, associated with that. But I think we have to do it in the right way at the end of the day.
Really appreciate the conversation and you taking the time to join me today. Thanks so much, Chris.
Yeah, thank you, Diego. Appreciate it.